Investing in real estate syndications can be a great way to earn passive income, but it's not without its risk. In this video, we're going to break down the 9 main risks you need to be aware of and give you the tools that you're going to need to protect yourself and your investment. And if you're new here, I'm Dr. Jeff Anzalone. A periodontist is on a mission to get you out of the rat race with passive income streams. Download my own passive income guide I've got just for you below the video. Now, recently, one of my Passive Investor Circle members, a 45-year-old anesthesiologist, reached out wanting to know more about real estate investing and syndications. Currently, he was heavily invested in the stock market and he wanted to start building additional sources of income. He actually wanted to retire in 8 years. He was interested in just getting some basic information regarding the risk of these syndications because he's like me, he has 2 kids and capital preservation was very important to him. Risk analysis is important because every investment, including real estate, it also comes with some level of risk. But there are some risks that are actually higher than others. As a passive investor, it's important to know what these risks are so you can make sure that they've been addressed. So without further ado, let's get into the 9 most common risks in syndication investments and how the sponsors try to deal with them. All right. So when you invest in a syndication, you're putting your money into a project that's being run by a general partner. Usually it's up to this group to do all the heavy lifting, such as finding the right property, acquiring the debt. They raise capital from investors, property management, then eventually sell the property. Even though they take on the majority of the risk, it's important to understand the information that they present about their deal so that you can make the best investment decision for yourself. So let's talk about the 9 investment risks. Number 1, first one is liquidity risk. A common question I get is, hey Jeff, if I invest in a syndication, when can I get my money out? Well, the project's whole time makes these passive syndication investments illiquid. So if the asset is expected to be held for, let's say, 7 years, then you can expect your money to be in the investment for 7 years. Unlike stocks or mutual funds that you can actually just go into your phone and sell with your app at any time, that's not the case with real estate. So the bottom line is this. If you're investing, let's say $100,000 with something with like a 5-year hold period, then make sure you won't need that money during that 5 years. Number 2, market conditions. Now, in the run-up to the 2008 recession, many investors mistakenly felt that the real estate market could only go up. The underlying notion was that if you bought property today, you could sell it for more in the future. Market risk is linked to changes in both the national and the local real estate market. If the economy enters a decline, all asset classes suffer. On the other hand, even if the economy is doing well, there may be downturns in the local market. Now, while real estate values tend to improve over time, the real estate market is always going to be at some point volatile, and your investment actually may lose money. Real estate trends, including prices and rental rates, are influenced by typically the supply and demand, economic conditions, interest rates, demographics, whatever the housing markets are in that area, government agencies and regulation, and any unforeseen events. You may reduce your chances of being caught on the wrong side of a trend by conducting thorough research, exercising due diligence, and monitoring your real estate holdings. Number 3, structural risk. Not every real estate investment is perfect. The chance that property could incur unanticipated changes due to its physical condition is known as its physical asset risk. This is especially true for older buildings. Now, these types of property, they may need expensive repairs due to structural problems, thus reducing its profitability. Typically, the group that's buying the property can limit risk by doing technical due diligence. And once the condition is known, there actually may be ways to negotiate lowering the price. Number 4 is location. When it comes to real estate investing, more than likely you've heard the phrase location, location, location. Location should always be your first consideration when buying an investment property, but it can also be a risk. I learned this firsthand when I invested $50,000 in my very first and last crowdfunding deal in Tulsa, Oklahoma, with a website called Realty Shares, which is basically it's gone under. So the sponsor felt that dumping money into rehabbing an apartment complex would, in a really bad area, would somehow get tenants to move back in. Had I known up front when I made the investment that the area was high in crime, I would have never invested in the first place. And that's what I get for trusting a website to give me information. And so the more that you know about an area before investing, the better. And this is another reason why I don't do crowdfunding deals. I only deal with people that I know and get to know on a personal basis. Number 5 is negative cash flow. So to calculate the cash flow generated by a property, you simply take how much income remains after all the bills have been paid. When the money coming in is less than the money going out, this is known as negative cash flow. Some of the things that can contribute to this are high vacancy rates, if the rent isn't high enough, if you have any loans with high financing costs, and if you have expensive maintenance. Preparation is the key when looking to mitigate the risk of negative cash flow. Make sure you spend time estimating the expected income and expenses as accurately as possible for positive cash flow. Now, you should be provided this whenever you're investing in a syndication up front, so you can make these calculations yourself. Number 6 is tenants. The number one reason I choose, and I've chosen passive real estate versus investing as an active investor, has to do with tenants. It's just too difficult to work in my dental practice and be a full-time dad while being a landlord. The main risk tenants impose is their ability to pay the rent. Something else to factor in is investing in property with only a single tenant. So if you have a single family home, you have to factor this as well, because these single family homes are generally riskier compared to properties that can house multiple tenants, such as multifamily real estate. Now, the reason for this is that when there's only one tenant, guess what? The occupancy rate with one tenant, you have one tenant, so your occupancy rate can only be either 100% if it's occupied or 0% if they move out. And when they do move out, the longer it takes to get property rented again, the more money that you lose, thus increasing the risk. Number 7, debt risk. Most real estate investors, including syndicators, they use debt to buy the property. Before you invest, it's critical that you understand the risk involved. For instance, if the loan is non-recourse, collateral is required by the lender, which can actually be seized in the event of a default. Other issues may arise due to debt maturing risk or over leveraging. It's also important to understand something called the DSCR. All right, that is the debt service coverage ratio. All right, you need to know, you need to understand what it is. You need to know what it is on the property that you're investing in. Again, whether it's active or passive. So the metric actually indicates how much debt is covered by rental income. So for instance, if you've got a property with a $900 a month mortgage and it's actually yielding $1,800 a month in rent, well, the DSCR is actually 2.0, $1,800 a month in rent, but only a $900 mortgage. So lenders may actually include a minimum DSCR in a loan covenant that the investor is obligated to meet. Most of the banks, they don't lend anything below a 1 to help prevent over leverage. Number 8 is cap rate risk. Cap rate is used to indicate the rate of return expected for a property based on a ratio of the current income to the market value of the property. Investors use this metric to compare properties and estimate their potential ROI. Let's say you're buying a home, and let's say you're looking at a house that's like $300,000. So you're going to look at the comps, or what the comparable properties are. So there may be a house across the street that's $400,000. There may be one that's $375,000, and there may be one that's $300,000. So you kind of look at what the other homes cost around you. You don't do that for commercial property. Typically, you look at the NOI. What is that building? What is the net operating income of that building producing? And that's how you determine what the cost is going to be. So cap rates are calculated by taking the net operating income, so all the income coming in minus expenses. That's the net operating income divided by the market value. That'll give you the cap rate. So typically a syndication, a sponsor will actually give the projected entry cap rate when entering into the investment, along with the exit cap rate. So whenever they get into the project, they'll say, hey, this is what the entry cap is. And then whenever we're exiting it, let's say in 5 years, this is what we're projecting the cap rate to be. Even a very small cap rate change can have a big effect on the property's value. So to reduce risk, it's a good idea to research the current market of a property to ensure that the projections don't show too much of a decline in the cap rate from entry to exit without a good reason, which may be too aggressive a property. So the lower the cap rate, the higher the price. And then the higher the cap rate, the lower the price. And last but not least is the sponsor risk. Again, in a syndication, there's two main groups. There's the sponsor and then there's the limited partner. The sponsor is also known as the operator, the general partner, or the syndicator. Again, they perform all the active duties due to their history of real estate experience. All right, so they're very hands-on. So not only does the sponsor invest their time, but they also invest their money. Typically, this amount can range from anywhere from 5 to 20% of the total equity capital for the investment. Limited partners are also called LPs. They're very hands-off. This group invests passively and owns a percentage of the real estate. They don't have to do anything regarding taking care of the asset, but they still get the benefits of actually owning the property. They get the tax advantages and they get the cash flow. Really, their only job is to make sure that they get their K-1 each year to give to their accountant and look for their quarterly distributions to hit their bank account, basically mailbox money. So there's actually two types of sponsor risk, and those are asset management risk and property management risk. So the asset manager actually oversees carrying out the business plan, and risk increases when he or she's not able to make the project happen the way that the business plan says it should. Property management is also important to the success of each asset, especially those where daily customer service is a must. So for instance, one of the reasons people choose a short-term rental to stay in has to do with reviews centered around property management. So if they go to Airbnb and they're looking and they're trying to figure out where they're going to stay if they're going to, let's say, Destin, they're looking at a beach house. So they're looking at the different reviews, right? Just like if you went to Amazon and you're looking for, let's say, a football, and you're looking at the reviews, which one has the best reviews? Because there's just so many of them. So when they're looking for the short-term rentals, if the customer service is subpar, this can have a negative effect on its success, all right? And actually, speaking of short-term rentals, what I want you to do now is check out this video over here where I discuss how you can invest in short-term rentals either as an active or passive investor like I do. Check it out over here.